Okay, we've come to a very important section, which is candlestick price bars. We understood that the open, high, low, close price bar was kind of the foundation, but the candlestick bar is an alternative to that, and a much, much better alternative to it, and really what people mostly always use. And there's a lot of things you can do with candlestick price bars, and that's what we're going to learn about in this section. And they're a better alternative, and they've been around actually a long time, since like the 18th century. They're called Japanese candlesticks because they kind of originated, or did originate, in Japan, where traders were applying it to the rice market back in the 18th century. So this is not some new voodoo or anything like that. These are really well-established things that you can use by understanding the pricing, but also how these different price bars interact together, and looking for some candlestick patterns that we're going to learn about as well to show us some trading opportunities for sure. So if we think about it, the open, high, low, close will tell us a lot about what's going on with the price in a day, but candlesticks will tell us this and much, much more. And in general, if we think about what are some of the benefits of candlestick bars, and you'll see as we look at some examples, they're going to be more visual. They're going to tell you a lot more just by instantly looking at it. As you learn it, you're going to see that they're going to be simple to use and interpret. Maybe not at first, but it won't take very long for you. You can look at a candlestick and say, I know exactly what's going on just by glancing at it for a second as you get used to them. So they're simple to use and interpret. Patterns have some descriptive names, which are kind of fun, easier to remember, like a Gravestone Doji, So we'll learn about those and how to represent these patterns that are, really good patterns for us to trade around. And the patterns are widely known, so you can expect other traders to respond in specific ways to specific patterns, which is a good thing. If everybody sees something like, let's say, a Gravestone Doji, which again we'll learn about, and then people are going to react in a certain way, well, that helps us as traders to see which way the market sentiment is, which way things might be going, and we can trade on that too. So things where patterns and things work together with a large group of people is a good thing. And you can use it on any chart, candlesticks that is, and you can use it with other indicators, which is really powerful too. So you can use a candlestick, and you can use it other indicators like a moving average or other things that we'll learn in the course, and you kind of use them to kind of work together to give you more strength around your decision-making process. So candlesticks really help that way. And they can have dramatic shapes or patterns to them that really grab your attention, and it might help you to react faster than like a standard price bar where you're seeing these lines and things, you're trying to match up the tick marks. Candlesticks can tell you stuff visually very, very quickly, and they can have these dramatic shapes to them, like real high and lows, or very narrow bodies to them, different things that we're going to see. And so it can help you to recognize certain turning points, such as an uptrend or a downtrend, by just looking at these candlesticks. So very, very, very important, these candlestick bars. And let's dive into that here in the upcoming lessons so we can learn more about them and how to apply them. Well, the first thing we need to do when we're talking about candlesticks is understanding what they're trying to tell us, right? They're trying to tell us something. And so we need to be able to interpret what the candlestick price bar is trying to tell us. If you look at this example here, we have a red one and a white one. And these candlesticks are trying to tell us something about the pricing, the range of prices, the opening and the close, whether it was up or down. But we need to learn how that works. But you can kind of see, just looking at these two examples, that the candlestick bars price bars get their name because they look like candles, right? You have a body that looks like a candle, the main body, and you have a wick on top. And also with the candlesticks in technical analysis and pricing, you have a wick on the bottom too. And they can vary in different lengths and all that, as you'll see. But that's the idea, is they kind of look like a candlestick, or a candle, which is great. Now what's it telling us though? This is great, Steve, looks nice, but give us a little bit more so we can understand what this means. So if we look at these two here, and now we're going to look at how to interpret them, right? So what is this telling us? So let's start with the one on the left. Let's start in the middle here, where you look in the middle where it says upper shadow, real body, and lower shadow. So all candlesticks share these upper shadows, real bodies, and lower shadows. Some are different lengths, of course, but in these two, they're exactly the same lengths on all these. The upper shadow is basically that straight line that you see on both of them going up and down. The real body is the rectangle, kind of the body of the candle, and the lower shadow would be like the wick on the bottom part of the candle. So you have an upper wick and a lower wick and a body. Again, you'll see they can vary in size as far as height and all that. So now if we look at the candle on the left, the red one, you can see that the high of the prices of the day is at the top of the wick, at the top of the upper shadow. So that's telling us in this price range that would be the absolute high that the security traded during the day. If you jump down to the low at the very bottom, you can see the other wick where it goes down towards the bottom. That would be the absolute low in terms of prices. When you see these on a chart, you'll see the different prices and things, and you'll see all these candlesticks, and you'll see their highs and lows based on the wicks, the upper shadow and the lower shadow. Now the body itself tells you something. So the one on the left, you can see at the very top of the rectangle, at the top of the body, that's the opening price. So that line, that horizontal line, would represent what the price was at the opening of the trading day. At the bottom of the rectangle on this one, it would show you the closing price at the end of the day. What is the closing price? And then the color of the candlestick actually has meaning, so you can instantly see, did the close occur higher or lower than the opening? You can see this one being red on the left there is a down day. Prices went down. So the prices opened higher, but at the end of the day when the prices closed, they closed lower. So just by looking at the candlestick color, you can see, red, down day, right? So I know my open is lower than my close, and my wicks tell me my high and low. The same thing on the right-hand side with the green one. The difference is that the close was higher than the open. You probably see that on the real body. The top represents the highest price for the closing price, which is higher than what it opened at. So it opened at where the open price is there, and then it had a range of highs and lows, but then it finished the day at higher. So the way you can tell that instantly is you can see that the body is filled in with either white or a different color, for example. So I know if I see a red body in this example, I know I had a down day, right? It opened and then closed lower. If I see it's a white body, I instantly know in a pattern of these candlesticks over several days that this one was one where it closed up higher than it opened. It may seem a little confusing at first, but it's not too bad. You'll get the hang of it here real quickly. If we look at let's say if something is bullish, as in the prices go higher, you can see again, here's that representation of the open being lower and the close being higher. Bearish would be where the candlestick is, typically red in color, and it would show a opening higher but then a closing lower. So it's a bearish or decreasing type of candlestick. And these candlesticks can be, green and white might represent bullish, red and black would represent a bearish one, depending on the price chart you're using, the platform you're using. And the open and the close depends on the color. It'll be at the top and the bottom of the box, and that'll indicate the color depending on what happens. But your lows and your highs will always stay the same. Your high will always be the top wick, and your low will always be the bottom wick as far as the price ranges. Here's an example of the same exact security. Shows you the same period, what it would look like as far as with an open, high, low, close bars versus, let's say, candlestick bars. And you can kind of see they look similar, but they also look different too, and as far as what you can get from them. Now, one thing with candlestick bars is there's things that can be indicated. They give you more information within a pattern or the shape of the candle itself. Here's a closer look at the candlestick bar chart as an example, and you can start seeing that you have these different heights, right? See how some are really kind of squat, short and squat, and some are real long. Some have real long wicks at the top. Some have no wicks at the top, or very little, and long wicks at the bottom, no wicks at the top. In fact, you can see these one here over on the far left. You see some in the far left, after the long, kind of in between where it starts to rise up a little bit at the first part. You might see a candlestick that has a very long top, but not much for difference between open and close. So it has a very small, almost like a line across for a body. And that's actually called a doji. And there's actually things we trade around. That's a candlestick with little or no body, and it's a special case. And it's where the open and close are occurring at or near, the bottom. If it happens near the bottom, it's a gravestone doji. This is an example of a gravestone doji where it's occurring more towards the bottom. It'd be a different name if the same thing happened but occurred at the top. Open and close were near the top. So we're going to learn all about dojis here coming up because they're very important in terms of recognizing a trading opportunity. But the real takeaway from that is to understand that these candlesticks can have different shapes, and they're trying to tell you something when you look at them both within their own individual candlesticks, but also when we start looking at patterns of candlesticks coming up, going to give us a lot of trading information. And some people, all they do is trade off of candlesticks. That's all they focus on is candlesticks. I like, you can use them and then use other indicators with them as well. I think is very powerful. But a lot of people, they just love candlesticks in these different patterns, and it works well for them. So let's look at these interesting situations that occasionally come around called dojis, and what are they trying to tell us? And more importantly, how can we, what are they telling us and how can we use them to be better traders, basically? So a doji is a situation where a candlestick has no real body or only a very small one. And the reason that happens is that the opening price and the closing price are at or very near the same level. So if you look at this graphic here on a typical candlestick, you see you have a pretty good sized body, real body, the rectangle part, with a wick at both the top and the bottom. And as you know from a previous lesson, those are called an upper shadow and a lower shadow. Now, if you look at these Doji candlesticks, one's got the open and close more towards the bottom, and not much of a candle body there. There is a body there, but it's like if they're almost exactly the same price, you're not going to see that width of prices between the open and the close, because they're all close together. Same thing with the one on the right, the far right, where the price is opened high or higher, and then it closed high near the high as well too. So there's still a range. You can still see the vertical main line down the middle. There's still a long wick running through and affect the entire candlestick with a high upper shadow and a low lower shadow. But the doji is showing a very small candle itself, the body showing that the open and close are occurring near each other. And because that happens, we can learn things around that. Now, on its own, though, a doji doesn't tell you all that much just looking at it alone in space. Other than that, there's indecisiveness in the market, right? There's no clear highs or lows, or excuse me, and there's no clear opens and closes that where it's going up or down as far as that. And really where a doji gains its meaning is based on the bars preceding it. What is happening before it? Because a doji can help indicate that a transition may be coming, and what type of transition depending on the type of doji. So think of that way. Don't think like, I see a doji, I do something. Think, I see a doji, I need to look backwards a little bit to see what might be happening next, and that'll help me with my trading decision. Do I buy? Do I sell? What do I do? So dojis, kind of work along with the other price bars. So a doji that occurs after a prolonged uptrend means buyers are coming in, and there's been this long prolonged uptrend. The prices have been rising, and you start seeing a doji. That could mean that it's coming to an end of their buying or bullish enthusiasm as far as a doji occurring after a prolonged uptrend. That would be like a series of like white or green bars, for example, of candles, those candlesticks showing that. And that might be the end of that trend. And that's called a bearish doji star, right? Bull means things are going up, bearish means things are coming down. So we have this long uptrend, and so now we see dojis approaching or coming in that might show indecisiveness, and we might be ready to make a move now the opposite direction or down, thus a bearish doji star. A doji after a prolonged downtrend, the exact opposite of that, where we've been going down for some times, means buyers might be coming in and they're getting more enthused about that security, and they're starting to buy that security, and that prices might be ready to start coming up. So it's been going down. We've had a series of red bars. There's now a doji that might be appearing, showing some indecisiveness, maybe showing us that we're ready to make that turn and go back upwards. And that's called a bullish doji star. So you have bearish doji stars, bullish doji stars acting in the opposite ways. But that's the idea of these doji candlesticks that could show, where these changes might be occurring. So what do we kind of learn from that if we think about it now a little bit closer? What we know is that a doji is kind of a transitional indicator. It's not a continuation indicator. A trend's going to continue. If anything, it's going to tell us that a transition may be coming. That the trend, whether it's going up or down, is going to change. So if you're investing, let's say, along a certain trend, let's say a buying trend, you want the prices to go up, and you start seeing a doji, then you might say, it might be time for me to get out and sell, because that upward trend might be willing to change. Again, they could be up or down, depends on the way the trend is going. And then the stronger the previous trend, the more likely that the doji is actually going to correctly signal a change. So if it's not a very strong trend, kind of in and out, it's not that strong a trend, the doji might not be as impactful. But if you've had a long, real strong bull upward trend and you see a doji, there's a very higher chance that the doji will be correct, signaling that change in transition. Again, nothing's perfect, but it's something you definitely want to be aware of and maybe adjust your trading based on that. And then lastly, in the next lesson we're going to learn about, there are certain doji shapes actually that have extra meaning. So we know a doji is going to be a transitional indicator, and the trend might change. Stronger the trend, a real good chance it's going to change. But then how that doji looks provides even more meaning. So that's coming up in the next lesson around doji candlesticks. Oh, in our previous example too, where we saw actually a couple dojis back to back, did it signal that there was going to be a change in trend? Well, not really that much, because the trend before it was not really fully formed. It was not a strong trend. You saw our trend was really a couple, days of pricing. There was a big, down day with that big high volume you see over there on the left-hand side. So maybe there wasn't a big strong trend leading up to that. And if we look back a little bit further on the right-hand side, you can see before had a real narrow trading range, up and down, kind of following this narrow channel. Then it started to go up a little bit. Dojis appeared. Was it going to go back down? We were watching for it. As it turned out, it didn't really make a transition, but it was something to be aware of. And then that trend actually continued. So if I was looking at this on the right-hand side, I'd say, okay, we started to trend up. A couple dojis appeared. I was watching it. And then the trend continued up after that. You can see because they're, black and they're, white candlesticks, and they're up higher, and even the ranges are higher. Their open, their close are higher, or their close is higher. I would say, maybe I am going to get a nice strong trend coming now because even the dojis couldn't throw it off. So another way to look at that. So a special shape around a doji can occur around the shadows. Remember, the shadows are the wicks of the candle. Upper shadow would be the upper wick. The lower shadow would be below the real body, would be the lower wick, like on a typical candlestick. As you can see in doji candlesticks, they have highs and lows, of course, and they have a range of prices, just the open and close are near each other. But when we look closer at what might be happening at the top part of the wick versus the bottom part of the wick, either one might be able to tell us a little bit more information, and there's certain doji patterns or indicators around these shadows that can give us more clues as far as what might be happening next. So let's take a look at some of these here. So what shadows do is they provide special meaning when the real body is a doji. So for it to be a doji shadow indicator, you have to have a doji open and close are near each other in terms of price, or exactly or pretty close on. And if you see that the shadow is missing, not much of, let's say, an upper shadow, let's say you have very little or no upper shadow, that's an indication that something's happening. Or if the shadow is extremely long, let's use that same upper one where it might be very tall. Those are situations where we have dojis, and these different lengths of these shadows can be very impactful as far as telling us, from patterns that have happened in the past, what we can expect. So there are some common shadow patterns to watch for, and they can have, real interesting names too. But the main thing is you want to watch for these patterns, because dojis can be rare, but if you see them, they might be a great opportunity. So let's look at these common doji shadow patterns, again, looking mostly at the wick and see what that might be telling us. So the first one here is a Dragonfly Doji. I love that name, Dragonfly Doji. You can see the image there on the right there. And if you look at just the image, what is it telling you? Just look at the image for a second. It looks like a T, I guess. But it's really telling you that the open and high and the close were all the same, right? A doji by its nature, the open and the close would be similar or at the same. But in this case, that the actual high was the same as well. So not only open at the high, and close at the high, the whole price range at the very high of the whole price range was at the top. So you'd have this long lower shadow doji, right? So the doji below it is a long lower shadow, and that's a Dragonfly Doji. And really what's happening here is that, the price opens, and sellers are really trying to drive the price down. They're trying to see if somebody will sell for less and establish a new low, right? They want the close to be below the open and try to establish a new low. But they didn't succeed. In fact, not only did it not succeed, it got pushed back up to the point where the open and the close were a doji and were the same, and near the high it started at the opening of the day. So how you interpret that, and you always need to look at the bars preceding a doji to interpret a doji. Again, dojis don't tell us things just on their own. You got to look at the bars preceding it, the candlestick preceding it. So the preceding bars are in a downtrend. We're trending down. Then buyers are emerging, and the downtrend may be ending. Think about it. It opens lower because we're in a downtrend, and they try to go lower still, but the buyers say, we think we're ready to buy. We think this is too low. and then they come in, they drive that price back up, drive up that from that lower shadow, because we see the range on the low, and they drive that price back up. So in a downtrend, buyers are merging, showing a transition. Remember, dojis are transition indicators. If the preceding bars were in an uptrend, then sellers are emerging, preventing the buyers from moving to a higher price, and the uptrend might be ending. So you think about that. We opened at this price. Buyers might be wanting, let's go higher, but oh my gosh, there's all these sellers just drove everything low, and the buyers just couldn't even move it above the opening price. They got kind of stuck there. So it's another way to look at it, but it shows the uptrend might be ending. So again, the doji itself, you can't look at that and say, oh, we're going to start buying. Oh, we're going to start selling. You have to look at the preceding bars and whether they're in a downtrend or an uptrend. And you'll see that with some of these other examples as well. So that's a Dragonfly Doji. Let's look at a Gravestone Doji. So if you look at that one, it's kind of the exact opposite, right? You have a long upper shadow. You have a long upper wick. The open and the close were the same or approximately the same. Again, that's the whole concept of a doji. If you had a thick real body, then it's not a doji. But this one is, because the open and close are the same. No real bottom, shadow. It's all upper shadow. And so what's happening here is the buyers are trying to drive the price up and establish a new high, but they didn't succeed. Opened at a price, tried to drive it up, came all the way down. The closing price was near the opening. So again, we're going to look at the preceding bars, and the preceding bars were in an uptrend. Then what's happening? Sellers are emerging, and the uptrend might be ending. So we're trying to go up. Buyers are saying, let's push this baby up higher even still. But sellers are saying, no, we're going to bring this down at least to our opening here, and we're going to bring it all the way down for the close back to opening. And so that uptrend might be ready to transition or end. Same thing with preceding bars in a downtrend, just the opposite. Buyers are emerging, preventing sellers from moving the price lower, and the downtrend may be ending. So we open on the left-hand tick side. They might be thinking about trying to go lower, but buyers are like, nope, let's get this high range up here. Let's try to end on a high note. Doesn't end up that way. It ends up coming back down to the close being the same as the open. So that's the doji, but it's an indicator that things are happening and a transition might be on its way. So be watching for that if you were in a downtrend. Another way you can look at dojis too is if they're missing shadows. So sometimes the shadow can be very long or very long or short wicks. But what they're really kind of or long in one direction or other. But what if they're missing a shadow? Like let's say you have what's called a shaven top. You can see in these examples here for a shaven top where there's really nothing going on as far as higher highs. There's no real high other than the opening of it or the closing, depending on how you look at it. But they have this long shadow on the bottom. So these are two different examples. So if the opening is at the high, and it's all downhill from there. So in the red one, we know it opened at the top of the rectangle, top of the candle, and then went down way down as far as that long candle, that long wick at the bottom. But there's nothing really at the top. That's a shaven top in a downhill or downtrend. And you think about it, it's kind of a double bearish, right? Double bad for prices, right? Not only is the day down, but there's no buying really occurring even after the open. Everybody was kind of selling and kept driving the price down. We know from that it's a red candle that the opening was higher than the closing because it's a red candle body. And we know because there's no wick at the top that there really was nobody trying to drive those highs up. Now, as opposed to the green one, it's the same thing. It has a shaven top, no higher highs, but the close is at the high. Again, our opening is going to be at the bottom of a green candle, at the bottom of the rectangle, and it's going to go up from there. Well, it might have gone down for a while. Sure, there's a low range, but it closed at near the high. And there was no higher highs in terms of a range, but it's a real positive sign that the close went really kind of pretty much up from there. So that's a shaven top. And you got to look at that one individually to see, what's the trend doing, and, what's really also, especially, what was the opening and what was the closing, whether it's a bull or a bear type of thing. Are prices rising or falling? Bearish prices are falling, bull prices are rising. The opposite of that, shaven bottom, right? So we can look at our candles, not much wick coming out of the bottom there at all. It's all kind of a main body, and then, of course, a wick at the top. So if we look at the green one there, a bullish shaven bottom, we can see that it opened at the low of the day. There was not anything lower going than that. There's no wick below that, and that the buyers really dominated to drive that price up. So it was really a bullish thing. They drove it up even higher if you went all the way up the wick, but it still settled up higher than the opening, but there's no bottom in it, so it's a very bullish sign by itself. The opposite, of course, would be if it closed at the low, then sellers are dominated. It's a red candle, so the top of the rectangle would show us our opening, bottom would show our close on a rectangle, opposite of a green one, or of our real body, and it would show that it closed lower. So the sellers dominated. So even though it opened and tried to go up higher up that wick, it really ended up down as far as in the closing prices were right at the bottom. It wasn't like it went lower and then went back up a little bit with a wick extending out of the bottom. It was like, no, we're going to get this as far down as we can, and we're going to close there at the end of the day. And that's what happened there as far as with a shaven bottom. Now, these missing shadows, shaven bottoms or tops, if they're really long, that can mean something too, as far as the wick or that range is very long. So the shadow is as long or longer than the real body, right? So that's the key you're looking for, are these really long wicks around them, and they got to be longer than the actual real body itself to be a true, long type missing shadow. Again, may or may not follow through into the next day, so that can be a little tricky. It's not a guarantee, but it's certainly definitely an indicator. And again, you want to judge relative to the preceding bars, but you can kind of see here what that might look like as far as the shaven tops or shaven bottoms and really long wicks with these really long missing shadows. So let's look at that. So if you have a really long, let's say long upper shadow, long upper wick, so the high of the day is well above the open and close. Remember, it's going to be longer than the real body. So the high of the day is, the absolute high of the day is well above what it opened at and what it closed at. So the price series is an uptrend, right? So think about, we're going upwards in prices. That's a good thing, going up. And you see a long upper shadow that shows the failure to close at the higher high. And that actually may signal an uptrend is over. It's like, okay, we're still in trend. It's still a green candlestick. We still went up. Our opening was lower than our closing because we know it's of a green triangle. But we know that we tried to drive that price up real high and even a higher high, but we didn't get there. So it may signal when you have a shaven bottom and you have a long upper top in a uptrend, that uptrend might be over. And then really just the opposite in a downtrend, right? The long upper shadow shows buyers are willing to buy at higher levels, and it may signal that the downtrend is over as well too. So look at what's preceding and then look at your candlestick and see what color it is as far as the opening and closing, and then be watching for these long, really long missing shadows as far as going up the top there. Same thing with the bottom, as far as coming out, a long wick coming out of the bottom, a long lower shadow shows that the low of the day, the lowest price of the days in that range was well below the open and close. Remember, it's a long wick you're looking for, not just it's a normal wick, it's got to be longer than the real body. So if the prices are in an uptrend, we would know that because it's a green real body. The long lower shadow shows that traders are not willing to buy at higher levels right up to the close. They're exiting at the high, and they may think new highs are not justified. So it may signal that the uptrend is decelerating, it's not as strong, or it may actually even signal that it's ending, so you want to watch that closely. And then the same thing with prices or series is in a downtrend. The long lower shadow shows a failure to close at the low. We didn't close at the low, otherwise it would have been a narrower or maybe a shaven bottom, but it's actually showing a shaven top and a very long wick, and that may signal that the downtrend is weakening or over as well, as we closed higher than those lowest of lows that were very, very long, very low lows. It closed up higher than that. So there might be an indicator to watch that an uptrend might be happening. Now, if you see something like this, would you immediately jump in and say, oh, I see that red candle with that long wick, I'm going to buy at the next opener, I'm buying right now. One thing with the trends, you want to make sure that trends become, establish themselves by itself. This is not telling you, it tells you to be watching, but you shouldn't necessarily take action on it. You should be waiting for that uptrend to develop. You just be aware that a downtrend might be ending, and it might be going either sideways or it might even be reversing to a full uptrend, and to watch for that. And we'll learn later in the course about how we can use confirming indicators to confirm these types of moves. But again, really looking for these long upper and lower wicks, missing shadows, in addition with a missing shadow in combination, that can really tell us quite a bit. So candlesticks are beautiful things where they can tell us a lot by the real body and the upper and lower shadow, what might be happening with prices in that day and what might be happening in a series of prices. So by themselves, they tell us quite a bit, but they can tell us even more when they're part of a pattern, right? We looked at like shaven tops and shaven bottoms and different things, and we said, well, you got to look at the preceding trends. Was there an uptrend or a downtrend? But there's also patterns of candlesticks where if you see certain things happening in terms of a pattern, that can be a very, very helpful indicator itself too, and you can trade off of those patterns. Now, two candlestick patterns might have different meanings depending on where they fall in a series themselves. So not only the individual price bars, but the candlestick pattern in part of a larger series of uptrend or downtrend, and we're going to learn all about that. And I tell you, people really like to focus on candlesticks themselves and trade just on candlestick patterns. As you learn the patterns, they can be pretty easy to trade off of. You can kind of understand them easily. They work well as far as working with another indicator, like a moving average or other types of indicators that you will learn in the course. They can kind of pair well together that way. So let's start looking at some of the real common, candlestick patterns that you want to be watching for, and when you see them, there's certain actions you can take to help you be even more profitable in your trades. Two of the most well-established and really classic candlestick patterns are the hammer and hanging man candlestick patterns. So let's look at those and how to recognize those. And these you'll see fairly frequently, and you can kind of watch for them. People really love to trade candlesticks, really watch for hammer and hanging man a lot of the time, and that's how they trade. So in a hammer, you have an established downtrend. You can see here how we have those four red candlestick bars. So that's showing our closes are lower than our opens each day, and we got lower lows kind of going each day. And then a hammer is going to mark the end of the downtrend. And what you'll see is where you're going to get a green type bar, and you're going to have a long wick on the bottom. That's what you're looking for, is a long wick on the bottom, and not much wick necessarily on the top, but you're looking for that long wick on the bottom. And what's happening is, sellers are able to create some new lows. That's why you have the long range to the long low there on the bottom. But last minute buying overcame it and actually created a higher close. So it started off as far as the opening being lower again, like the trend was continuing. And then they tried to drive, the sellers were trying to sell even more, and it was real bearish, and things were trying to go even further down in price and really continue a strong, let's say, downward trend. But now prices have really kind of reached their exhaustion level on the lows. And buyers are saying, no, this is maybe a good opportunity to buy. And so they push up from that whole range of lows, a real long range, and push it up and actually create that the close is going to be higher than the opening, and thus changing the color of the bar. And then you'll see it kind of being confirmed over the next days. You need to let the trend form and all that, but this is a good recognition that something's going to happen. And you can see over the next couple of trading periods that now we get more into an upward trend where we have higher highs is what we're seeing there. So you're looking for that downward, on a hammer, you're looking for that downward trend, these low lows, and then kind of a reversal from there as now buyers get back in and say, no, we got to move this up. This is way too low as far as the price. Now, a hanging man is essentially the opposite. You have an established uptrend where things have been trending upwards. Each close or each open is higher than the close from the day before. We have green candlesticks in this case. But a hanging man marks the end of an uptrend. And if you own the security, that's the time to sell as far as at a profit. On a hammer, you're looking to get in and start riding a new trend going upwards. But if you own a security and you see a hanging man, now it's time to let's watch, because this might be the time to sell. And what's happening is, bulls, or people who have faith in the security, they're unable to keep the bears from making a new low and from keeping the close below the open. They want to continue that uptrend. They want to see that uptrend happens, but what's happening is the uptrend doesn't continue. You have, again, this very low lows. Again, it looks like the hammer where you have a shaven top, but then you have a long wick on the lower shadow on the bottom. But you can see how it's how the candles change from green to red that the close is lower than the opening. And so now we're anticipating a reversal, and you'll see that play out in a true hanging man pattern, where now the candlesticks afterwards continue. Maybe they could go a little sideways, but you're probably hopefully looking, or you might see a more of a downtrend there and anticipate that. So hammer and hanging man, the actual candle itself has a shaven top and a long wick at the bottom, but you want to see where they are at in the pattern. That's the key part. You can't just look at it itself and say, this is what it is. You need that pattern coming before to kind of confirm that it's that it's establishing this true hammer or hanging man chart pattern, and then you can trade that indicator accordingly. Let's talk Harami and engulfing candlestick patterns. They're similar, but yet slightly different too, of course, as well. And let's start with the Harami. And Harami actually means pregnant in Japanese. And you can, if you look over on that samples I have there on the left there, you can kind of see where you have a small real body comes after a bigger body before it. Here we have a long red candle, and then we have a short real body in terms after it. So you can almost imagine it's like somebody might be pregnant or whatever. And that's the idea behind a Harami, is that you have the small body coming after a big bodied candle. And you want to look at the color of the candle makeup. It's green followed by red would be a bearish type sign, and red followed by green would be more of a bullish sign. So in our example here, you can see that we have a red candle, and then that is followed by a green one. So this would be a bullish one. And you can kind of guess at that because you can see there's going to be an upward trend following afterward. And what a Harami is really telling you is it's an indication that a change in sentiment is coming. Something's coming. So if you're looking for an indicator that say, hey, there might be a reversal or some change coming here, Haramis can be very helpful for that. And the smaller the real body on the second Harami, the more powerful indication that the reversal is coming. If it's not much difference between the two, then it's not really a Harami. You're looking for a taller or longer real body candle followed by a shorter kind of squat, small, difference one followed by after it. And you're looking at the real bodies of these candles a little more so than, let's say, the wicks going up or down. But that's where you're looking at these open and closes around the candle. So if you're looking at this Harami, you'd say, okay, we can see we've been in a definite downward trend, or we've got a couple, basically 3 red candlesticks in a row. Boom, all of a sudden, this narrow trading range, but the opening is low and the close is higher, so it changes the candle color to green. That it's now a higher a higher close than the open after we've been, in a downward trend, signaling that a trend change might be coming. Now, as we know with trends, we want to make sure we let the trend develop. We could see this and say, it's definitely Harami, and it turns out to be a false signal. It's not Harami at all. So once we see that second day and certainly that third day, now we're starting to see more of a confirmation that a real trend reversal has occurred, and that now we can be trading off of that. How soon you get in, you might be a little bit more related to your risk and and how you want to judge that, and be whether you want to be quick on Harami or whether you want to let that form more and be a little bit more confident. But either way, you're looking at a real body, a bigger one followed by a small one. Just look at the which one's preceding which to see whether that's a bearish signal or a bullish signal. Like the Harami, engulfing candlesticks also will signal a reversal of a trend. So you're looking at trends and you're seeing if it's going to continue or be changed or reversed. And that's where engulfing candlesticks work just like Haramis. But it's if you look at the images on the left here, you can see what's highlighted in the square. It's kind of the opposite, right? You don't have that pregnant type look. You have the opposite, where you have something that's shorter and smaller being engulfed by something that's bigger. And that's the key thing. You have to wait for that second bar, in the example in the box here, to occur. You can't just guess, we have, let's say, an upward trend, and all of a sudden we got a shorter real body and say, we're definitely going to have a reversal. That could not be true at all. It could be just a little it's just a matter of a trading day, and in terms of open and closes, and the trends is going to continue. They usually don't look this, clean and neat. You're looking for something that's going to engulf it. And that's really what's happening, is there's a wider range of the opening and closing than the day before. And if you can look at either of the examples, you can see that the second day in the box is bigger or wider or basically taller, and it's going to completely engulf. And that's the key thing. It's going to completely cover or engulf the opening and closing of the day before. And if if you have a higher opening and a lower close in this engulfing candlestick, that's a bearish sign. Prices are going to start headed down. And if you have a lower open but a higher close, then that's a bullish signal, and then prices will start rising. And in both ways, you're looking at the previous, what's happening before, to see if there's an established trend, because this is all about trend reversals. It really works when there's a trend, not so much when there's no trend yet at all. So if we look at that example up in the top with the bearish engulfing, we've got a nice strong trend. We've got higher highs going on there. Even that small little short one there of that candlestick is still a little bit higher than the high day before as far as the close. And so everything's going green, everything's going up. And then all of a sudden what happens, you have this big engulfing candlestick. So you see that engulfs it. You have this big red thing where the opening is opening higher than the day before, but then the close is going to go lower than the close the day before, and that's why it's a red candlestick. And so that's telling there's a lot of downward selling pressure. And that's where you need to wait for the next one to just confirm it. This will look like it, and some people, you can trade right on that and say, oh, that looks real bearish to me, I'm just going to do it. And that's okay, you're taking more risk that way, and you have a bigger chance for being wrong or a false signal. But you can certainly do that as far as your own risk and reward pattern around that. But if I look at, let's say, now the second red candlestick that's coming outside the box on this bearish engulfing, I can see, okay, now I'm seeing lower lows, and so now I think we've got a true bearish engulfing pattern here, and then I can, if I own the security, I would sell it. I would sell at some point here to get out because I've already made my profits on that nice trend going up, and now I want to take my profits. Now, if I look at the bullish engulfing, maybe this is a security we're not in because it's going down in price. We have a definite downward trend with all those red candles down there. And then we have the similar thing, just the opposite. We have a lower low, a short body in the red, that's then engulfed by this nice big green candlestick, the real body of the candlestick. And so we have our closing is it's higher than the open and close of the red candlestick. And, everything's being engulfed in there. We wait for the next candlestick outside the box to kind of give us some confirming, waiting for that second bar to happen, and that price bar. And we can see, yeah, this is a trend reversal. Look, we're going upwards now. So this, when you start seeing things like engulfing candlesticks, think, is a trend being reversed? Is there a trend, and is the trend being reversed? And wait for it to happen. The longer you wait for it, you're going to lose a little bit of opportunity cost where maybe you could have gotten a little earlier, but you're going to have less losses as far as being wrong or a false signal. It's really good to let these engulfing candlesticks kind of truly, form a little bit and have that second bar, the one outside the box, so basically, and to kind of both bars basically, the engulfing one and the one after it can be really good confirming patterns with engulfing candlesticks, and they work just like Harami's, where you're looking at trend reversals. So shooting star and window candlestick patterns are very interesting patterns themselves here. And in a shooting star, we'll start with that one, you have a small real body and a long upper shadow, right? And what it's doing is it's implying the failure of a trend to continue. It's a failure to close near the high. Certainly the high being in that whole upward shadow, that whole long upward line on the trading range going up. It's not getting you near how high it got during the trading period, the trading day, for example. It's coming back down. So if you can see in the example here, we have a green candlestick, and if there were, let's say, there are other ones out there before that, so we're on a trend upward. I threw in a doji just for fun. Sometimes you'll see shooting stars after dojis. Again, a doji shows that there's indecisiveness, so maybe there's been a trend. We haven't had a real, let's say, reverse or anything, but we have a doji saying, yeah, they might be getting a little indecisive. We could either keep going up or keep going down. Or go sideways. We got to watch, and then boom, all of a sudden we see this shooting star. And we see that, basically, that there's a high established as far as at the opening, but the close is closing lower. That's why it's a red candlestick, because the close is lower. A close is lower than the high, or the close is lower than the opening of the day. But in that candlestick, that first red candle, you can see has that real high kind of shooting star, like kind of like the shooting star as far as the range of prices. So there was a lot of higher prices going up there. There was people trading at much higher prices, but it all started to come down, towards that real body there on the shooting star. And then you want to see what happens next. It's a good indicator that you've got a failure of the trend, and then we're going to go sideways or start a reversal of the trend and start going downwards. So if you shoot a shooting star, be aware that if you've been owning a security, that might be a time to get out or be wary of that and be ready to kind of pull the trigger and take your profits. A falling star would be the exact opposite pattern, by the way, if you were looking at, let's say, like a falling star, and that would be more of a bullish signal, where this is a shooting star is more of a bearish signal. A different type of signal, and this kind of works with our gaps, if you looked at the lessons around gaps, is rising and falling windows, right? And so really what you're seeing is it's kind of like a gap up. It could be a breakaway gap, it could be a runaway gap, but for a rising window, you have basically a gap up. And what happens is the third day in the pattern does not go down to fill the gap. Sometimes people trade and they're like, oh, I anticipate it's going to go down because we had this gap and it's not really a lot of volume behind it, not a true, let's say, breakaway gap. So that third day, it's going to come back down as far as what we'd be watching for. And if it doesn't come back down, then we have a true breakaway gap. And this would be in a case of what you could call a rising window pattern, where the gap isn't filled and the upward trend continues. So you're kind of looking for this pattern in this example where you have a rising window where you have a gap, and then you have that continuation of the trend. It doesn't go back and fill that gap. Kind of fulfills that whole definition of a gap that we learned about other lessons too. The same thing with a falling window. You're really looking at a gap down, right? We're looking at our bars from left to right. We can see we've had some downward trend. That's the red candlesticks in a falling window versus the green candlesticks in a rising window. So we have this candlestick. Now we have a gap, and they're both red, so we're both going downwards. Our prices are falling. And then the third day in the pattern does not go up to fill the gap, right? It doesn't go up and do that to basically fill the gap and try to maintain that more overlap. It's going to keep going down. And so that's more of a falling window and really kind of a confirmation that the gap is a true gap and that the trend is being a really established trend is happening, and that trend is going to continue. Again, breakaway gaps are going to look at creating new trends, or this could also have been a runaway gap, which is a continuation of a previous trend that we're not seeing on the images here. So look at the gap lessons again to see, to reinforce stuff about gaps. But basically what's happening in rising and falling windows is the trend is going to continue after the gap and really be established versus coming back downwards and filling that gap. And that's what you want to watch for. Let's look at 3 soldier and the counterpart of 3 crow, and basically a 3 green or soldier one would be 3 green or white, depending on your charting software. But basically you've got an upward trend. You've got 3 long green bars. That's the key thing you're looking for. You've got 3 long green bars, and they're all consistently all in a row, kind of lined up like little soldiers, right? They're lined up like if you have plate soldiers or something, and they're all lined up in a row. And it's really showing the continuation of an uptrend. And really what you're looking for is that they're longer green bars, and that the consistency part, they're very orderly. It looks like they're marching in formation, so to speak, or at least marching upwards in formation. And that's a continuation of the uptrend. That's the indicator that you're looking at. And the stronger that indicator would be is if the top wick, the top part, upper shadow is short. And so it's showing that the close is at or near a high. We don't have real long wicks showing that it really went up real high, but then it came way back down. This is just a nice orderly, it's just following like little soldiers going right in a pattern going forward. And really the key thing you're looking at in a soldier pattern is that it's consistent. Both these patterns, you're looking for these kind of consistent looking bars, not a lot up and down, just real orderly. And so that shows a strong indicator the trend is going to continue and go in that same direction. Now it could be going the opposite direction, a downward direction, and then we'd be looking at 3 crows. And sorry, candlesticks would be red, or again, depending on your trading platform, could be black. Either way, it's going to be the opposite of something that's trending up. We're looking at 3 red bars. And they're going to be the same thing. You're looking at longer red bars. You're not looking at dojis or very small real bodies. You're looking at, really good kind of consistent long red bars. Again, all consistently in a row. Less like the soldier pattern. They're called crows because they're going downward. So decided to be a crow. And it's going to continuation of the downtrend. You're looking at it and say, yep, prices are going to keep going down. I see these 3 red crows. They're marching in nice, orderly fashion. I'm going to, then trade accordingly around that. And so the stronger the indicator would be if the bottom wick is short, so that's showing where the closes are at or already near the low. They're not going way, way down, and certainly there's no real long upper wick trying to drive highs. They're real consistent red bars going in the same direction. In this case, for a crow, they'd be red and prices would be following, but you wouldn't have a long wick at the bottom. So the shorter the wick, the better the indicator. And again, looking for both these patterns, what you're really looking for is that there's consistency. And that's why the number 3 is important there, because 2 can give you an idea or something like that, but you start getting 3 and they're all consistent like that, then that's a real, really proven kind of pattern out there. Nothing's perfect, of course, but a real proven pattern showing that we're moving in a direction either with the soldiers going upwards in a trend, and that's going to continue, or with the crows going downward in a trend. So look for these chart patterns. Well, I hope you enjoyed this powerful section on candlesticks and candlestick patterns. I want to leave you with some final thoughts. And one thing, too, as you start to see patterns, you start to see more and more candlesticks, they'll become more second nature to you. So if it seems like it's like a little bit harder to grasp, you can always go back and watch a lesson. And again, as you actually start using it, whether it's with paper trading for practice or in your real live trading, you're going to start seeing these things very, very easily, and it's going to help you to become a very successful trader. So some final thoughts around this is, one, you want to continue to learn and practice and learn to visually recognize what these candlesticks are trying to tell you. They're trying to tell you something. So the more you understand the candlesticks and you can, and their patterns that go with it, especially the Kahneman patterns, and you can just visually look at it and see, oh, that jumps out at me. I know this is what's going on. That's going to be very helpful, and that will come as you learn and over time. And also that there are many candlestick patterns out there. I've shared the most common, most classic ones that almost everybody can use and maybe should use, but there are a lot of different patterns out there. If you search the internet, you might find all sorts of patterns. In fact, if anything, there's too many patterns, and they can be detrimental because some are not as, statistically valid as others. The ones I've shared with you are ones that are the best ones. So if you try to learn too many patterns, you can have this steep learning curve because you're trying to keep all these patterns in your head, and that can actually, cause you to be impact your trading in a negative way. Other things is you start to see all these patterns, you might start seeing things. You try to learn too many patterns at first, and you might have mirages where like, oh, I think I see this, but really it's not there, right? It's a mirage. And you start getting where you look at your charts and everything starts swimming around like, oh my gosh, everything seems like a pattern or nothing seems like a pattern. So start by focusing on, patterns that seem most interesting to you, or certainly the ones that I've shared with you. Start there, and then you can build from there if you want. But too much can be sometimes, not helpful either as far as candlestick patterns. And as I mentioned in a couple of the lessons, I said that some people only trade candlestick patterns. They just really focus on that, and that's okay. They can be successful that way. I would say take some of these other lessons that you're going to learn and think about that. If you love that idea of candlesticks and trading just these candlestick patterns. And by the way, sometimes a lot of these patterns are not as common, so your trading might be not as frequent too. If you're looking for just a certain doji setup or a certain pattern setup, it might not be as common as other types of patterns out there. But a good practice too is you learn other things in the course is to combine it with other indicators for like confirmation. So maybe I see a candlestick pattern forming, I might confirm it that, okay, volume is doing what I'm expecting to do, either rising or falling or staying the same. So the trading volume is there, confirming, but I might want to confirm it with other things I'm learning, like trend lines, moving average, weighted moving average, simple moving average, trend lines, general trend patterns, upward trends, lower trends, these moving averages, momentum indicators, sentiment indicators. There's things that we're going to learn throughout the course here that you can use, that if you see a pattern from a candlestick aspect, you can go outside that to something a little bit different and say, okay, I see this happening. I'm going to use a momentum indicator and see if that actually confirms what I'm seeing here. That both my candlestick pattern and my momentum indicator are saying prices are likely to rise, well, then I'm going to buy because I'm getting a double confirmation. And we'll learn all about that too towards the end of the course, where we talk about kind of setting up your strategies and stuff too. But right now we're learning the tools and how to apply these tools and how to apply them to be, so you can be very successful. And I tell you, candlestick patterns, great section here, and really get into that, and that can really, really make a difference in your trading and help you to be very successful. So let's learn about some more indicators and ways to interpret using technical analysis.